Hello everyone, myself Deepak Gupta, and today we will take up the important balance between risk and the return and how an investor judges it. So, if I am starting correctly, every investor who has surplus funds wants to invest so that he gets the desired returns. But whenever we talk of the return, obviously we have to quantify how the returns are calculated. Secondly, whenever this investor who is looking for returns, he believes that he should get guaranteed returns. But as so many ads in RBI to justify that there is nothing like guarantee. You cannot guarantee a return in any scenario, though there can be cases where the risk is low, or we can say very low, or the risk is high, or we should say the risk is too high. So, whenever we talk of the return, there is a word who is always associated, and that is the risk. And this investor who is looking for returns always want that there must be highest return, but he does not want the risk. So he want this risk to be lowest. Now, whether we are able to achieve this opposite combo, that is to be discussed in detail in these sessions on risk and return. But one thing is for sure that ideally, if you take higher risk, then you get higher returns. So we can always promise that if you take low risk, then obviously the returns will be low. And if you take high risk, then the return must be more than what you anticipated. But to keep them in opposite position like above, that is quite a task to be completed, and that depends upon the expertise of the investment manager or your wealth manager. So whether he is able to achieve that or not, that is not our purview at the moment. But one thing is for sure that whenever we use this word risk, it shows a sense of uncertainty. Uncertainty of what? Uncertainty of how much you are going to get as return. So we have to measure how the returns are calculated, how they are calculated, and secondly, what is this risk and how this risk is similar or different from the word uncertainty. So obviously, risk is whether you are going to get the returns as anticipated or not. So it may happen that if you want a return of 12%, then either you get it or you don't get it. So it's a kind of uncertainty. But still, the primary difference between the risk and the uncertainty is that the uncertainty is non-measurable. You cannot measure, it is non-measurable. So if certain uncertainties becomes measurable, we can measure it, then we use the word risk. So what we are up to here, that though risk is a kind of uncertainty, but it is unlike uncertainty measurable. So we can say risk effectively is a measurable uncertainty, यानी कि ऐसी uncertainty जिसे आप measure कर सकते हैं. So question will arrive that how to measure it, and one of the important ways of measuring can be through the concept of probability. So what we are going to start in this first session on risk and return, that how the returns are to be calculated, and because the risks are measurable, so how the risks are to be calculated through this concept of probability. That is the first and primary focus in this series, and from where we will be beginning this journey of risk and return, and that is the prime focus in this part 1 of the series, how that risk is measured through the concept of probability. Sure, but before we enter into that arena, we should understand that primarily the risk, it arises from where, what are the sources which gives rise to the risk, and secondly, what are the different types of the risk. So these two concepts will in together support each others in understanding the overall concept of the risk. So when we talk of the sources, the risk can come from the market. So we can say the risk is market oriented or the risk is coming from the market. Obviously, whenever there is an investment scenario, there are various options which are provided by various vendors. So that creates a source of or sense of market. And there will always be uncertainty in this market because of various factors which may be macroeconomic to the country specific or maybe to the world specific. For example, in today's times of war, this market is always having high risk, is having high volatility, so it's a kind of market risk. Or it may be because of the interest rate which is available in the market. So similarly, there is always that a say that Indian markets of financial investing are so much affected by the US markets. Or we can say because US is the strongest economy in the world and the biggest economy in the world at the moment, or how we perceive it this way. And there is a risk of uncertainty over the US markets in current times because of the Russia war or because of the unemployment or because of the corona side effects or because of the huge inflation, and that inflation can also be a source of the risk, and this inflation may cause the US Central Financial Authority, commonly known as US Fed, to increase the rate of interest on the government bonds. And that increase in the interest rate will always affect adversely or positively, that is to be discussed in detail when we will do it. But normally, if the US hikes the Fed rates, interest rates, then there is normally an adverse effect on the equity market all over the world because of the drying liquidity. So, inflation, market, and the interest rate can be various sources of the risk along with inherent business risk. This business risk, which is normally measured through operating leverage, and this operating leverage normally denotes the ratio of contribution to EBIT, and the difference between the two is the operating fixed costs. So operating leverage comes from the operating fixed cost. So we can say that if the operating fixed costs are high, then there is high operating leverage, and that is why we have high business risk, and it may affect the returns from the securities adversely. For example, in these corona times where the production was not as anticipated because of the decrease in the demand, and hence due to decreased sales the contribution was low, but normally the companies were not willing to take off the employees, so they were having high fixed operating cost in the form of labor cost, and that could have caused high operating leverage, high business risk for the industry, and that has adversely affected their prices in the market, and hence subsequently affecting adversely the returns of the investors. The another kind of risk can be the financial risk, and this financial risk is measured through the concept of financial leverage. Through the concept of financial leverage, and this financial leverage is primarily denoted as the difference between EBIT and EBT, ignoring preference capital. So if we ignore that there is any preference capital in the funding of the company, then the ratio of the EBIT and the EBT denotes financial leverage, and it is because of the interest on debt. So we can say that high interest on debt, that is high cost of funding through debt, increases the financial leverage of the company. So there is quite a side effect that because of the high operating fixed cost, the EBIT is low, and because EBIT is low, primarily because of less contribution means less sales, it means companies are generating lesser profits, but because they are having high fixed costs, therefore there may be an increase in their funding from debt, and that increased funding has vice versa obviously increased their cost, that is the interest on debt, and it has also affected the financial leverage. So a company may be suffering from two hammers at the same time, that because of the decreased sales, the operating leverage has already increased, and because of that also the company may fall into the debt trap, which will also impact or increase their financial leverage, and hence these all kind of risks can be associated with a business, and that will affect the returns of the investor, and that is why they are all various sources of the risk. Now, if we move further, that if we analyze these risks clearly, then some of the factors are common for all industry. For example, as I said, that this corona has not just impacted any particular company, it has impacted the whole participants of the industries, barring a few, for example, IT industries. Similarly, this Russian war situation has also impacted more or less all industries because of the scarcity of demand, or sorry, I should say the scarcity of supply of oil, gas, metals, food items, and therefore these are certain factors which are common for all. So these factors which are common for all, they constitutes the systematic risks. But if there are certain factors, for example, this business risk, or I should say the financial risk, it is not always that all the companies will increase the fixed cost. Some of the companies may have reduced the fixed cost through various other measures that have been anticipated. Similarly, not all companies must have increased their debt quantum and hence increase their financial leverage, as the owners may have put their personal money in the form of the equity and not adversely affecting the financial leverage. So there can be certain which are not common for all, or they are not common for whole industry, but entity specific. So they can be entity specific risk. So these entity specific risks are known as unsystematic risks. So whenever we measure the uncertainty associated with a particular investment option, then we have to identify whether the risks are systematic or whether the risks are unsystematic. Because if they are systematic risks, then they are going to affect the whole economy. But if they are unsystematic risks, then it is affecting the particular entity, and therefore the investment planner, can always keep away from such individually risky securities or individually listed industries or the organizations. So, keeping in mind this type of risk, now we should first move towards the calculation of the return, and then we will try to measure the risk through probability and incorporate it with the return to arrive at the concept of expected return. To arrive at the concept of expected return. So what we will do, that we will calculate the returns from an security, and we will show the return as R, and we will also try to judge their risk through the measure of the probability, and we'll measure the probability by showing P, and based on this we will try to calculate the expected return. So this expected return is return with inherent risk, and that has come from the probability, and there will be shown as R bar. So before I move into this concept of return from security, so here we normally use the word HPR, that is holding period return. So ideally what is happening, that an investment, for example, say equity, will generate two kind of returns. First will be the capital gains. So if we take a 1 year horizon of any equity investment, then the difference between the market price after 1 year and the current market price. So this P1 denotes the market price after 1 year of investment, after 1 year of investment. And this P0 will denote the current market price. So basically this is what was invested and this is the value after 1 year of investment. And the other investment that could have been from the equity is in the form of the dividend, and if we show it as D1, presuming that it is a dividend which has been received after 1 year of investment. After 1 year of investment. So ideally, this D1 plus the capital gains is showing the total returns on investment of P0, that is the current market price. Therefore, this HPR shall be equal to D1, that is the dividend, plus capital gains upon my initial investment. Because how is that coming to be? That HBR should be equal to dividend plus capital gains upon my initial investment. That is why this HPR has derived from this concept to this formula. So, if I take one example, that an equity was purchased at a current market price of say rupees 50, and after 1 year the dividend received was rupees 4, and the market price after the end of the 1 year was say rupees 53. So in this case, capital gains will be 53 minus 50 is equal to rupees 3. The dividend will be obviously rupees 4, and the initial investment is rupees 50. So we can say that HPR will be equal to 3, that is the capital gains, plus 4, that is the dividend, upon my initial investment. So that will come out to be 7 upon 50, that is 0.14, that is 14%. That is 14%. So if there are two securities, securities X and security Y, and they both have their HPR calculated as above. They both have their HPR calculated as above, and the HPR of the security X is 14% and security Y is 16%. So we can say the security Y is better in terms of the returns. But this choice may not hold good until we calculate the risk. So it may happen that this security Y having higher returns than X could also be having high risk, and that high risk may not support the investment choice of selecting Y. So therefore the choice has to be based on return as well as the risk. And once we are able to incorporate risk with this return, then we'll arrive at the figure of the expected return, and here we will measure the risk through probability. And once we are able to do that, then we can make a choice between X and Y based on the concept of expected return. So what we are going to do, that we will calculate these expected returns based on probability in our next session on risk and return, so that you are clearly demarcated between the basics that have been discussed in this first session and the inherent risk calculation through probability, and how that affects the return to calculate the expected return. And thereafter these expected returns will be used to create or to calculate the concept of standard deviation, and that standard deviation will stand as the absolute measure of risk, shall stand as the absolute measure of risk. So we will in the next session start with the calculation of the expected return, and inherently we will calculate the standard deviation in our next session. On this note, myself Deepak Gupta is logging off from this platform, and I hope to see you again on our next session. Thank you very much. Goodbye.